So so we said that the revenues that were earned and any expenses that we had, the expenses that supported the revenues have to show up in the same period as the revenues. And the buzzwords are revenues earned and expenses incurred. And we said we could care less what happens to cash, right? Because it's not a part of our thought process. So revenues. Everybody agree that our revenues is $1,200? We went out and laid the patio and we charged $1,200. All right, so our revenues are $1,200. Now we've got expenses. So the decorative stones, did they help support the revenues? The answer is yes. Do we care when we paid for them or bought them or anything else like that? Not a part of our thought process. The only thought process is, were those expenses incurred to produce a revenue? And the answer is yes. So we got stones. $400. How about the two $10 cement bags? They were purchased and paid for in April. Do we care when they were bought? Do we care when they were paid for? No. The only thing that we care about is that we used them to produce the patio. Wages paid to assistants, $200. These wages were paid at the end of the week, so that's pretty clear that that goes into an expense, right? We had to pay our help to put down the patio. All right, then the little tricky one is that we spend $600 per month on all these miscellaneous, and I said this was a 4-week month, and we're doing a 1-week income statement. So 600 divided by 4 tells us that $150 of these miscellaneous expenses have to go into that job because they were incurred in producing that job. If we didn't have this, we wouldn't have the company. So $150 of these monthly expenses have to go and be matched to the revenue. Office expenses of $150. All right, so we add those all together and we get $770 worth of expenses. We subtract the two and we get $430 worth of profit. Accrual basis accounting. Questions? So all those of you that were lost, does it make sense? So, under accrual basis accounting, do we care anything about cash? The answer is no. What we do care about is that revenues earned are matched with the expenses that supported those revenues in the same period. So this was our 1-week period. So we had the revenues of $1,200. We have to bring all the expenses that help support those revenues that were incurred in the same period. Matching principle, accrual-based accounting. All right, so teammate A on the left, turn to teammate B on the right if you haven't run them off, and explain to them what we just talked about in the last 5 minutes. Verbalize it. All right, so you're all experts now, right? So the teammate that was listening, turn to your other teammate and say, thank you for being brilliant. All right. So if you understand this, you're halfway to understanding chapter 3. Let's look at the rest of it. The adjusting process. So here's the story. Here's the month. All right, 131. All right. So all month long, you've been you're the bookkeeper or accountant. All right. You've been journalizing all the economic activities. All right. So that's step one of our process: journalize. Right? And then you You're posting the information to the ledger accounts, and then you created an unadjusted trial balance. This is on the last day. You're doing these couple things here. All right. Then it's 8 o'clock in the morning, the last day, and your boss comes to you and says, "Hey, financial statements, 5 o'clock tonight." You haven't seen your boss in 30 days, but he's pounding on your door now, right? And you say, "Oh, no problem, boss. No problem, boss. I get the financial statements." All right. So then he or she leaves, and you start scratching your head and say, "All right, now what do I do?" "Oh, yeah. I remember that guy. He told me that we have to do month-end adjustments or period-end adjustments." And the month-end adjustments, what does it mean? Oh, I know. We have to recognize all revenues that I haven't put on the books yet, or maybe they're on the books and we've discovered that we now call a revenue. And I have to put all expenses. Maybe they're not on the books. Oh, maybe they are on the books and we just need to adjust the books. Right. I have to recognize all revenues and all expenses. Why? Because if I left those off, what's going to happen to my financial statements? They're not going to be accurate. So the bottom line is accurate financial statements. All right, we're just coming up with a process in order to get accurate financial statements. All right. So that's the whole reason behind Chapter 3. So if you keep that in your mind, why Chapter 3 to get accurate financial statements? Yes, sir.
What's number 3 in the course
In our accounting cycle, journalize, then we post to the ledger accounts, then we create an unadjusted trial balance. That's Chapters 1 and 2. We're now going into Chapters 3 and 4, where when we do our unadjusted trial balance, it's now the end of the month, and we always do these adjustments on the last day of the month. The boss wants financial statements, so our first process is to come up with end of the month adjusting entries to recognize revenues and expenses that maybe not are on the books. So, our accrual accounting says that we've got to recognize revenues and expenses in the proper period and match them together. The accrual basis of accounting says that revenues are recognized when they are earned. Buzzword. What does earn means what? Perform, right? You call me to fix your light, I go out and fix the light, I've earned it, I've performed. I recognize it on that day. And that's called the revenue recognition concept. The matching principle says that all revenues and expenses that supported those revenues have to show up in the same period. The cash basis of accounting is we recognize cash when we receive it. We recognize revenues when we receive the cash, and we recognize expenses when we pay the cash, which is not a part of our thought pattern for this class. If you run a small business and your checkbook is your accounting, then you're on the cash basis of accounting. There's many small businesses that do that. But our rules say that we can't do that. So why do we need to do these end of the period adjustments? Well, some expenses are not recorded daily. Some revenues and expenses are incurred as time goes by. We're going to see all these examples. Some revenue expenses may not even be recorded. The books may not even know about it, and we got to throw it on the books. And this is all called the adjusting process. And what we're going to do is make adjusting journal entries to put it in the books. So indicate whether yes or no whether each of these accounts would normally require an adjusting entry. Is cash ever part of our thought pattern? So we would never do an adjusting entry for cash. Prepaid rent would be. When someone prepays rent, we create a liability, and over time, that liability comes down, and we recognize when we start performing the rent, so we'll look at that in a second. Wages expense would be another one that would be requiring, because we're dealing with revenues and expenses, right? Office equipment would not be adjusted. Accounts receivable can be adjusted, and unearned rent, again, can be adjusted also. So just to give you a little bit of flavor of what we're looking for. All right, prepaid expenses are the advanced payment of future expenses and are recorded as assets when the cash is paid out. So what is an example of a prepaid expense we've always been using in this class?
Will you pay insurance?
Absolutely. First, please. Good job, Christian. Here she comes. Take care of it. Prepaid insurance, right? You know, we booked it as asset. And you say, well, wait a minute. Insurance, why isn't that like paying the light bill and all that kind of stuff, right? Because we booked it as an asset because when we walked out of that insurance office, we had a 100% paid up policy that we have not used any of it yet. All right. And our buzzword says that we can only recognize expenses when we incur it. So time has to go by. All right. So what happens with a prepaid insurance account, remember anything prepaid is always an asset. What happens over time, 30 days goes by and we own a flour truck and we run flowers around town. So we bought insurance on that truck, 30 days goes by, we've used up 30 days worth of insurance. All right, so has that truck earned revenues in the last 30 days? The answer is yes. So the rule is all expenses that help support that truck's revenue have to be shown in the same period. Well, one of the expenses is 30 days worth of used up insurance. So now we're going to take the books and we're going to reduce this asset and we're going to increase the insurance expense for 30 days. Every 30 days we do the same thing. We reduce the asset, up the expense. Reduce the asset, up the expense. Why? Because that truck's earning revenues. We have to support it with all expenses. And one of them is insurance. So here's the story. We go in and buy our insurance policy. We shell out cash and we book it as an asset. 30 days goes by and we've used up 30 days worth of insurance expense. We're going to call it an expense. And what happens to our asset? It goes down. So asset going down, expense account going up. This is where the rules of debits and credits, you have to look at that and know exactly what's like that, right? You have to sit there and think about it. Go practice your rules of debits and credits. All right, unearned revenues are the advanced receipt of future revenues and are recorded as liabilities when cash is received. So Tyrone wants to rent a lot next to me because he needs parking for his restaurant. So he gives me money in advance. All right. Have I done anything to earn this money? No. So I can't call it a revenue. I call it unearned revenue, which we know is a liability. 30 days has gone by. He's used a lot for 30 days because I've allowed him to do it. I have performed, which means I've earned 30 days worth of revenue. So what are we going to put on the books? We're going to increase our revenue by 30 days, and we're going to decrease the liability. I'm not as liable to him as I was 30 days ago. All right, so that's how we do that. So here's what it looks like my books, he gives me the money, I increase cash, and I increase my liability. 30 days goes by, I'm going to recognize that my liability to him is going down and my revenue is going up by 30 days. This is called a deferred revenue. When we book it as a liability, we're deferring the recognition of revenue until I've actually earned it. And going back one more time with the insurance, it's called deferred expenses. I'm going to defer the recognition of an expense. I book it as an asset. I'm going to defer the recognition of an expense until I've actually incurred it. All right, so that's a deferred expense. This is a deferred revenue. 30 days has gone by. I've earned the revenue. I now can report it as a revenue. All right, let's try this one. Let's do 3-3. The supplies account had a beginning balance of $2,400 and was debited for $39.75. All right, so here's our supplies account. It had a beginning balance of $2,400 and we debited it for $39.75. Journalize the adjusting entry required at the end of the year, assuming the amount of supplies on hand is $13.75. All right, so that's just a fancy way of saying, hey, we started with $2,400 in our inventory. Then we went out and bought $3,975 worth of inventory. 30 days later, we went and counted another inventory, and we've got $1,375 worth of supplies sitting on hand. So the question is, how many supplies went from this room to out the door? And we know that once it goes out the door, it turns from an asset into a what? Expense, right? Because if it goes out the door, hopefully we've earned revenues. And the expenses support those revenues. So does anybody remember our formula? If you don't have that written down, or if you don't have it in your brain, you want to write that down, because that formula will use the rest of this class and the rest of your life if you deal with inventory. All right, so our beginning inventory was $2,400. Our purchases was $39.75. Our ending inventory is $13.75. And so our use is how much? $5,000. So we have to recognize, this is an expense, right? $5,000. And the question when you ask yourself, that's going to be our debit, right? $5,000 to supplies expense. What's happening to our asset? Well, our asset isn't as much as it was before, right? So this $13.75, how do we get that number? Well, if you do the math, add the debits, add the credits, subtract the 2, whichever side is higher, and to get $13.75, we got to put $5,000. So our supplies, the asset is coming down by $5,000. And this matches our ending inventory and everybody's happy. So here's what we just did. We recognize that 30 days went by. We know that we've used up some of our supplies. Well, the question is, how much did we use up? Because this number is nowhere on the books, right? So we have to adjust the books in order to recognize that the supplies went out the door, and we call that supplies expense. All right, so this is nothing more than a deferred expense. When we bought the supplies, we booked it as an asset, and 30 days has gone by, we've used it up. We have to recognize the expense now, and the asset is coming down. And that's your adjusting entry. Supplies expense debit. Supplies, the asset. How do you make an asset go down? All right, we got 3 minutes. See if you can do this one. See if you can do 3B, you and your teammate. Tell me what the debit is going to be and what the credit is going to be. Now we're talking about prepaid insurance. 30 days has gone by. We had beginning insurance of $7,200. We went out and bought another $4,800. And then the amount of the insurance account at the end of the period was $8,000. What's the amount of our insurance expense? And what's the correlating credit to prepaid insurance? Use the formula. Beginning inventory, 7,200. Plus purchases, we went out and bought another $4,800 worth of insurance. Minus ending inventory. In this case, the amount of unexpired insurance, our asset is now $8,000. Do that math, and that's going to tell you what your insurance expense is. What's the amount? $4,000. What's our debit? What are we recognizing? What kind of an expense? Insurance expense, because time has gone by. What's happening to our asset, prepaid insurance? It's coming down, right? How do you make an asset go down? Credit. How do you make an expense go up? Debit. And that's your adjusting entry. Beginning insurance plus what we bought minus the value of our ending insurance. This is where it is right here. So now you got to reckon that 30 days has gone by. When we do that math, we've recognized and we've used up $4,000 of that asset. That is going up and that is going down. There's our adjusting entry. That's called a deferral. We're deferring the recognition of expense until we've actually incurred it. So that's going to go up. And when do we do it? When do we do this journal entry? Last day of the month. Right after the boss leaves your room and says, "Give me those financial statements." You say, "Yes, no problem, boss. I'll have it 5 o'clock. So it's 5 o'clock. What happens? Blow the whistle. Time to go home. See you later. We'll continue this conversation on Thursday.